All right, welcome to the Growthcast. We're another Aloha Friday drip. Frickin' Jackson, Mother effing Campbell.
That's me, I'm here.
Tyler,
Mother effing Devereaux.
Whoa, shoot.
Nice.
Hey, I'm going to start out this way, okay? First off, whatever we're talking about, it's going to be fantastic. So I'm going to ask a favor to go leave a review. Dude, I just looked the other day.
Yeah.
And it doesn't even matter, even if this one's bad. I've listened to Dallas's drips all freaking week, and they're golden. So go leave a review, man. It's crazy. I didn't see very many, you know?
Okay.
It's just crazy.
Yeah, definitely.
So,
yeah, I mean,
go leave a review for Dallas and Jackson and everything that they do, man. But
wouldn't be possible without Ty, though. I'm not taking that credit. Wouldn't be possible if it wasn't for Ty.
I appreciate that. But if I'm going to leave a review, for those of you watching on YouTube, you can tell our TV's a little...
It's got a little malfunction here.
We put a little baby stripe on there.
Yeah.
What happened to the TV, Jax?
Backed into it with my chair here. We ended last week. I was just so hyped on the episode. I pushed away from the table too fast. Broke the TV.
You know what?
My bad. That's what
Back
cash
it
flow.
up,
That's
back it
what
up.
cash flow's for. So we can replace, right?
Miss Campbell taught you good. Yep. And that's what cash flow is for. Your cash flow. No, just kidding. That's what insurance is for.
Yes, definitely.
All right, let's dive in, dude. What are we chatting about today?
Passive investing.
What came out the freaking shit.
We're going to talk about passive investing.
Hold on. Last time I asked you what the topic was, and it was like this. You kind of like kept us on the edge. Today you're just like, boom, I'm going to slap you in the face with it.
We're jumping right into it. More specifically, we just opened a fund at MFCP, the Akahi Fund.
Yes.
Very first fund we're doing, and it was oversubscribed in 48 hours. So that's what I want to talk about today. I want to talk about the passive investing. Start right out of the gate. A $20 million fund. It was filled in 48 hours. In that first 24 hours, though, it was nearly filled. We had the second webinar, and it was like filled while the webinar was happening. So why do you think that was oversubscribed in 48 hours, and how did that happen? But before we do that, maybe explain what the fund is and what the difference between an individual syndication and a fund. What's the difference there? What is the difference between a syndication and a fund?
First off, man, that was awesome. You know, just very humbling thing to. It's an amazing thing. So I would love to talk about it. Why that is, because I have pretty strong opinions, which I'm sure is probably why you're asking me to go down this route. But so explain the difference between a typical syndication. Like typical, if you know, a lot of our listeners are probably used to a syndication model. In fact, we've had a drip on syndications, and a syndication is you're investing in an apartment with. So a specific apartment, I guess is the best way to put it.
Property.
Yep. You're investing in a specific apartment with partners, right? And the difference there with a fund is you're investing into the fund that now takes down multiple properties instead of one. So same investment, same type, should be comparable models, but your investment is now spread across multiple properties instead of just one. And there's a number of different pros and cons with that. I mean, one, your risk and return, your upside and your downside is now spread across multiple properties, which is a beautiful thing. The other side of that is, as a fund, we're going into these deals, similar type of a deal, a syndication deal, if you will. But now we're the biggest investor in that deal, which means we can negotiate a better position in that deal, right?
Makes sense.
Better preferred returns that filter all the way down into the fund. So, yeah.
Okay. I want to dive into some specifics there, but before we do that, Akahi. What does Akahi mean? Akahi
means one. So this is our first fund. Obviously, this is called the Aloha Friday, episodes. We live here in Maui. We love Maui.
We do.
Grateful for Hawaii. And so it's our first fund. So we decided to go with the Akahi fund. And Akahi means one. In Hawaiian.
Okay.
Which means if you did Akahi Aloha, that means
one love.
One love. One heart.
I love it.
Okay, we're done. We're not going to do that anymore.
We could do some karaoke there, for sure. For sure. Okay, why do you feel like the structure of a fund resonates with so many people?
Well, I think there's a couple things. I think the structure of a fund the idea of a fund, right, can resonate, but I believe that this took off for a number of different reasons, and it's because of how we structured. Like, I believe that this structure resonated with a lot of people because we focus more on abundance. Like, I believe in abundance, an abundance mentality, right? And abundance is, and I just believe, I was going to say like I believe, but I believe that this is a fact.
So it's not even believing, it's just a fact.
That's it, just factual.
Yeah.
Is that abundance is the most direct way to achieve really everything that we're looking to, right? Our goals are, increase our happiness, increase our wealth, all that kind of stuff. Mm-hmm. So I believe that I achieved financial security the day that I understood how to provide value. So the day that I focused less on money, which sounds weird, right? But the day that I focused less on money and more on ways to create maximum value for as many people as possible, that's when I believe that I achieved financial security. Yeah. So if you want more money, we have to provide more value. I'll tell you how typical funds structure. Typical funds, I believe that most funds are structured on, more scarcity based. So they structure in a way to help them keep and get more, which is, listen, any business is looking to get more, right? That's why you go into business. But the reason that's a slippery slope is because they desire abundance, right? They desire this abundance, but they are trying to achieve it through scarcity.
Right.
And that is never going to go the way that you hope it will, because your mindset is directed more towards scarcity than abundance. So
that's such a golden nugget. I hope that, like, I know we're talking about the fund, but in mindset and anything, yeah, that's a huge golden nugget. You can't expect abundance but be scared.
Yeah.
You can't. It's impossible.
Yeah, and believe that there's not, scarcity, meaning that there's not enough to go around,
Right.
And so many people, I just believe this, that they focus on, the more that they feel like they give, they feel like they're not going to get things in return. But I disagree. I believe that the less we focus on our desires and the more that we focus on helping other people get what they want, the more we get what we want.
I couldn't agree more. I couldn't agree more. Do you mind giving an example of that?
Yeah, so the abundance is scarce.
Yeah.
A typical fund, I'll give you this example. A typical fund will structure, and this is the same way that we were advised to structure, but a typical fund will structure like a preferred return. I'll explain a preferred return, but a preferred return is it's kind of like, we call it a floor almost, right? Yeah. Like it's the first amount that goes to investors, okay? It just means investors get paid first. That's probably the best way to explain that. So what these different companies that will structure fund, what they'll do is they'll structure a higher preferred return. Sometimes it's even a lower preferred return, but sometimes it's a higher preferred return, and they do that to attract investors. But what they'll do is they'll cap the returns on the exit.
Okay.
So, and why would they do that? Because they want to keep as much as possible, right? They've built these investor base. They have these, a track record. They have those kind of things. So these investors are maybe used to investing with them at this point, maybe. And so now what do? They structure in a way that they can keep as much as possible. So all that excess so let's say, for example, let's say that they cap the returns at 16%. That's what we were advised to cap the returns at, by the way. Offer a 10% pref, but cap it at 16. Yeah. So 10% pref with a 6% kicker, right? Capped at 16. Which means anything over 16% we would keep.
Yeah.
For example, our average annualized rate of return is, I think it's like 44% or something like that.
It's like 43.76 or something.
Shit! Jay.
I've been running numbers.
JC! So that means that if we were to truly structure that way, that means that everything past 16, so whatever 43.7269 subtract 16, that extra would all be ours. And that does seem like abundance, because that is abundance. That's a lot of money.
It's a lot of money.
It's a lot of money. But here's the downside. Most investors are pretty savvy. They're at least savvy enough to see that. And if they're not savvy enough to see that in the beginning, they eventually will see that, which means you're always on this hunt to try to find more investors, different investors. So I told you we were advised to structure the exact same way, but we didn't take that advice because we believe in abundance and we understand abundance. So our structure is different. Okay? Our structure is Well, dude, our structure is the same as always. Like, our structure is the exact same as always, meaning we don't cap returns on exits. The same pref returns. Usually, we usually do 6, 7, or 8%. That's the same as what we're doing now.
Yep.
We don't cap returns. Anything at 20%, past 20% annualized rate of return, we split 50-50. Same way we've always structured. So why is that? Why do I believe that that's smart? And why wouldn't I want to keep all the extra? Well, I do. We want to keep as much as possible. But I also believe that if you take care of investors, they'll invest with you for a lifetime. And not only will they invest with you for a lifetime, but dude, they'll tell others to do the same thing. So, you look at your value metrics as a company, right? And most people, if we were to ask somebody what the goal of their company was, what do you?
Everybody's going to say X amount of dollars.
Yeah. Okay.
There's going to be a number. We wanted gross profit, net profit, this much. X. Yeah, that's what they're going to talk about as profits.
And we have those
Absolutely.
goals.
We have those goals for sure.
But our value metrics, but it'll never come down to strictly dollars and cents for us. Like, you have to tie your value metrics to the right things, right? So raising money, I believe raising money can be done a whole bunch of different ways, dude. But if you raise the money the wrong way, it's deceiving because the metric looks like it's going up, but in reality, you're pushing people away from doing repeat business. So our value metric has to be tied to the result we're trying to achieve, like the education company, multifamily mindset.
Yeah.
The result that we're looking to achieve. What is the result we're looking to achieve on the education company?
Student happiness and success. Deals.
Yes.
Deals. We want our students to get into deals.
But it is even more than deals. Yes, deals for sure.
For sure.
But I love how you said student happiness and success, because success is doing deals certainly, but happiness, we're a mindset company too,
Yep.
So student happiness and success. On the investor side, the MFCP, multifamily capital partner side, it's tenant satisfaction. Well, dude, it's tenant and investor happiness and success, right? If you put it that way.
Yep.
Yes, we have goals. We want, $30 million in revenue, $400 million in real estate, but that's not our performance metric, dude. Our performance metric is what our customers are trying to achieve. So 30 million, 400 million, that's exceeded in the short term and then multiplied in the long term by value creation. And I believe, like, if we can get and I believe that we've grown to the point that we have because our company understands this. Like, everyone within the company understands this.
I think it's been one of the biggest separators for sure.
Absolutely agree with that.
Yeah.
And it takes some time for people to buy into that. But actually, man,
not our team.
Yeah.
Not our team.
I say that,
I
but
would
man,
not. Yeah.
I would say most people it takes them some time to buy in. But I agree, man. It has not been a battle, dude.
It hasn't.
There has been a battle with some people that no longer work with our company.
Right.
It's because they don't fit the culture, and that doesn't mean they're bad people. They're just not right for our culture.
Right.
But I believe that we will be a $1 billion company because of that. Like, there's no hacks. The hack is to be freaking great at everything you do for who you do it for. Right? Abundance will always win.
Always.
In that light. Yeah.
No, man, I love that. Man, so valuable right there, and such a huge takeaway. Just a little sidebar here. I hope you don't mind. One of the biggest things that I've learned working with Tyler, working with Ryan, working with Todd, working with Melissa, working with Dallas is this principle, this abundance principle. We're talking about it right now in funds and syndications and the difference there, and how we've structured our fund a little bit different with abundant mentality or abundant mindset. But carrying this mindset and this principle to every aspect of my life has been huge. Awesome. It's opened up the door for better and stronger relationships, new opportunities. It's a huge, very important principle that if you're not living it, you should.
I love it, bro. I love it.
Sorry, little sidebar there.
I love that because I believe it to my core, dude. I mean, think about what just happened with Eric Thomas as a quick example, man.
Man, special.
Awesome, right?
Yeah. Have we talked about that on the?
I don't think so.
I don't think we have. Are we? Can we talk about
sure.
that? Yeah. Do you mind?
Yeah.
Just a little example of abundance here at Peak Partnership. I'll let you explain it. But at Peak Partners, Tyler, I'll let you explain it. Go ahead, man. Go ahead. At
Peak Partnership. You were nailing the intro.
That's all I got out.
This damn mic keeps sagging on me, dude.
Oh, well.
It's like I find myself hunching over. Hold on. Just keep it up here. If we keep it up here, then I'll... What's up? Y'all, if you don't watch this on YouTube, you need to.
You should be.
We're pretty attractive dudes who do pretty cool things. Jackson, don't touch my boom.
I don't want it to be in your face.
So at Peak Partnership, I get to meet Eric Thomas, and I get to meet... dude, I love his stuff, man.
It's so awesome.
And he's exactly who you hope he would be, by the way, even more so. He's just a great dude. But I asked him... fast forward a little bit. I'm on this call. He's reached out to me a couple times after. Because I asked him, how can we provide value to you? That's what I asked him. And he was kind of like, oh, man, dude, I'm here to provide value to you guys. And then he's like, and, to everyone here. And he's like, well, actually, there may be something. Actually, you know what? Like, I have this program, this thing that we do that I think can, you know what? I would like to actually work with a couple people in your organization. We have this program that we put people through to help them get better results. And you know what? I'd love you to send me a couple people and, we'll work with them. And I was like, okay, well, so your way of us providing value to you is...
providing value to some of our people.
Yeah, providing more value, But then we get on this call, and the guy that is kind of orchestrating this, his name's Moose. Moose, if you're listening to this, Moose is a stud, dude.
Shout out Moose.
Yeah, he's a stud.
For sure. You said a lot of great things about him.
And he says, man, I got to figure out we're waiting for ET to get on the call, right? And he's like, man, Tyler, by the way, side note, I got to figure out, I want to pick your mind, man. I want to pick your mind about what you did, what you did with ET to get in the door so quick. And I was like, what do you mean by that? And he's like, dude, ET, he doesn't let people in the family like he does right now. Like, dude, he's very adamant about working with you, speaks very highly of you. Like, what did you, I want to know what you did, Then he brings it up once ET's on the call.
Which is a compliment.
Dude, and I'm literally taken back by that, whoa. I don't even know how to take that. And then he mentions it on the call, and ET he said, man, I told Tyler earlier, man, I got to figure out what he did to, penetrate the circle so quick. And he says, I'll tell you exactly what I did right now, man. When we're sitting backstage, he asked me a question I had never been asked before, ever. Speaking at, doing a speaking engagement, which was, how can we provide value for you? And it totally took me back, man. It was like, oh my gosh, this is, and I, my initial knee-jerk reaction was nothing, but then I was like, no, that's actually, this is exactly what I've been looking for. Somebody that has pure intentions, is looking to give, not just get, man. That's something that I want to partner up with and, be associated with, is what he said. And
that's awesome.
Dude, it was awesome. So I guess the lesson from that, man, is just, dude, focus on the experience you're creating and what you're giving, we invest so much money trying to get customers and investors, and that's so important, right? But if we can go above and beyond and give that investor, that person that's coming to speak at your event, whatever, an experience that they didn't expect, they'll tell everybody about it. They'll go online, they'll tell everybody about it. The masses will see it, and they'll become investor side. They'll become a repeat investor.
Yeah.
With Eric, they'll become a repeat person that you get to associate with, and I mean, dude,
and learn from and gain from.
Yes,
and so,
yes.
and I mean, it's just what that experience showed me is that it was yet again just another testament of an abundance mentality. You went in there asking, how can I provide for you, instead of wanting something for yourself. When I'm sure in that moment, it's Eric Thomas, 2.2 million followers on Instagram, getting ready to sell a book, very, 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 very successful. Very successful in his realm, in his space, and you didn't ask anything of him. You very well could have been like, yeah, man, let me pick your brain about speaking this a little.
No, I did. I picked his brain too.
But the first question you asked was for him.
Yeah.
What can I do to provide value for you? What can I do to make this a better experience for you? And that's the perfect example of an abundant mentality. So a little sidebar here on abundance, but I thought it would be cool to bring that up. For
sure.
I
love that, man.
Awesome. Where were we?
I think just, I don't know, providing value, abundance, how we structure with abundance. I think, I don't know.
Yeah. Okay.
I don't know.
Okay. Next, I'll just move on to my next question.
Okay.
On the call, on the first webinar, there was an individual who was almost kind of bad mouthing funds.
No, he was bad-mouthing me.
Was he bad-mouthing you?
Yeah.
Okay, he was bad-mouthing. Okay, he was bad-mouthing. That's what it was. Now I'm remembering.
Yep.
Now I'm remembering. He was kind of saying, he was saying some things like Tyler's reading everying right now.
Yes,
this is all scripted, blah-de-blah. He was kind of heckling.
He was straight up heckling, dude.
How did you handle that?
Well, first off, I didn't ignore it. I wasn't expecting that question, but I love it. I didn't ignore it. Right. No. There's two things that was happening. There was one person that was there not to learn about investing at all. They were there to, they knew it was a big webinar. In fact, we maxed out our capacity on the webinar, right? So it's like that's why we had to do two. And so what were they doing? Immediately they were trying to pitch their own stuff on there, right? I call that out and just bring it to light. And then I get, this, and I think that he even said more things that I didn't even know, but essentially he was giving me shit about a bunch of stuff. But I didn't, and I'm not looking at the chat the whole time because there's a bunch of chatter going on, dude. And I'm just, I can barely see the chat.
It was going so fast. It was. I couldn't even keep up.
But then I see something in my corner of my eye, and I literally interrupt Melissa, and I was like, hey, hold on. I just saw this in here. I just want to be very clear. There's a number of you who have invested with us for a long time, been, to classes we've been to, blah, blah, blah. And I pointed out how, have any of you ever, I think the reading part, I was like, have any of you ever been to one of my classes before and seen me just sit up there and read shit? And then all of a sudden the chat goes gangbusters on these people that we've provided value to, right? Having my back, dude. They fought the freaking battle for me, dude. Our past investors, it was awesome. It was awesome.
That's awesome.
So,
that's awesome.
Yeah, so dude, that goes in line. That's what we were talking about. That goes right in line with people going and telling the story or shouting out telling other people. That goes right along lines with that, dude.
Right.
Yeah. Anyway, I don't know.
That's perfect.
But that's funny, dude.
Okay, Ty. So at the very beginning, you talked about we've been talking about providing value this whole time, but you talked about how this fund's different. It's a different way to provide value because you structured it a little bit different than typical funds and typical syndications. Yeah. So is that what you mean by providing value, is just structuring it in a way that benefits the investor most?
Yeah. Yes. I think it goes a lot deeper than that too, right? And it should always benefit the investor most because they're putting in the money.
Right.
We're guaranteeing the loans, we're doing all those things, right? And we're putting in money too, but which means as we put in money,
but it's our deal. We should be putting that just makes sense to put money into.
Dude.
Yeah.
But it benefits us too. So yes, it's how we structure, but I think it goes deeper than that because ultimately we provide value. I believe we provide value by solving problems. In fact, one of the most valuable things you can do is solve problems, right? Most people run from problems, but I believe a success principle is to freaking look for problems to solve.
Yeah.
It's valuable, you know?
Right.
So, inflation is an example. It's a big hot topic buzzword, right? Inflation right now there's headline CPI, which that's just what they report. It's higher than this, but headline is 8%.
I know.
Which means if today, okay, let's say that you have money invested in the stock market or whatever, and your investment grows at 8% return in the stock market, that's really 0%. All you've done is keep up with inflation. So we literally have to grow our money by 8% just to maintain buying power. That's a problem, dude. That's a problem.
It's nuts.
It's nuts.
It's nuts. And I think it's something that a lot of people don't understand. It's a huge problem.
Agreed. I definitely agree. People get pumped about, a 3%, 4% raise, whatever, but they're not realizing that they're still behind.
They're losing money, actually.
Yes.
Yeah.
So we help investors hedge against inflation, right? How do we do that by buying appreciating assets. So the problem we solve, right, as inflation goes up, so do our rents. So as this paper money, right, as it goes down, as that value goes down, decreases in value, our real estate goes up in value, which is why it's considered a hedge against inflation. I would say that so it's the value that CRE, commercial real estate, right, the value that provides, right, and the problems that it solves. So inflation's one of those. I would say taxes are another one. As I look to invest in, one of the biggest things that I noticed when I started to invest in multifamily, bro, is how I was making more, but I was keeping more, dude. I was paying way less in taxes. In fact, the first couple, they're called K1s, but the first couple K1s that then turned into tax returns, right? And I saw that I made all this money, more money than I had ever made in my entire life, and but I owed less in taxes than I've ever paid in my entire life. I was like, what is this sorcery? What the hell?
Yeah,
dude? My accountant's a wizard, and he is a wizard, dude. But commercial real estate has awesome tax benefits, depreciation, cost segregation, bonus depreciation. This is the last year to benefit from 100% bonus depreciation, which just means we pay a lot less in taxes.
Right.
Like cash flow returns that we receive, that 8%, let's say it's an 8% in cash flow that I receive. I mean, it's not an exact science, but most of the time it's zero that I pay in taxes there. So
it's more than just structuring the property.
Totally, dude.
It's more. There's so many other avenues to provide value for not only the company yourself, but for the investors too. There's so many other avenues.
Peace of mind too, dude. Peace of mind too. Like think about, people are so nervous that the market's been up and up and up and up and up. So people are so nervous about a correction, right?
Yeah.
I never get nervous about a correction. I believe that a correction is actually where there's the most opportunity.
For sure.
But it's just being prepared of it, like this probability of some people would say even a recession. And, recession typically historically happens every 30 something years, whereas a correction happens every 12, 15. But that doesn't mean that a recession can't happen sooner. But so the probability of a recession, a correction, whatever, it's elevated over the next few years, but it's definitely not a foregone, for sure conclusion, right? Like the economy's freaking thriving.
Right.
Now I could go through stats, but it's thriving. Tons of jobs. I think it was 1.7 million jobs or something added in Q1.
Wow.
Unemployment rates are very low. But those are all positive forces, all great things, which is why I actually believe that inflation that we just talked about poses a bigger risk than a recession or a correction.
Sure.
This is why we focus on, our focus should be on hedging against inflation. But that being said, in a correction, in a recession, commercial real estate is one of the best places to be during, economic uncertainty. You look at just the market fundamentals or the multifamily fundamentals right now. Like vacancy rates are so low, which means demand, which is why rent growth is so strong, right? Demand far outweighs supply. And so the whole point of peace of mind, though, one of the best places to be in a correction is commercial real estate.
Right.
Also, it's our job to navigate that. We literally dedicate our, this sounds dramatic, but it's just the truth.
Yeah.
We dedicate our lives to navigating those waters. We study it all the time.
Yep.
Not just me, not just you, but our whole team.
Yep.
So we're always talking about it, always conversing about it. That's very valuable. That's valuable. Right?
It was so interesting. A little side story here along these lines is last week was Courtney's birthday. We went to get pedicures. The owner of the salon.
Get those dogs taken care of,
bro.
bro.
The owner of the salon was doing my feet. He was a gentleman.
Poor guy.
He was a great guy.
Dude.
Great guy.
That's valuable.
Very valuable. We were talking, and he's a real estate investor. He's a real estate investor, and we start talking about he does more single family stuff, and he poses that question: are you guys afraid of inflation? Are you afraid of the recession? And my answer so quickly was, no, man. That's what we identify as a company, as people who solve problems.
Yeah, love
That's
that,
what
bro.
we do is we solve problems. We continue to be profitable. We continue to close properties through COVID. So I don't see it being any different if there is a recession or inflation continues to rise. But I wanted to draw that example because it's right in line with an abundant mentality.
Totally.
It's more or less the same thing as being a problem solver, believing in yourself to be able to solve those problems, believing that there is an answer to that there is a solution to solve the problem. It comes
so good, bro.
It comes right in line with everything that you're talking about. So I wanted to pull that example.
Rewind, reverse. Anybody who's listening to that, dude. Abundance is exactly what you just said. That there's always a solution. There's always a way through it. Whatever, right? Mm-hmm. As long as you're focusing on that.
Right.
Do you know where people get stuck in a correction or a recession? It's when they focus on scarcity, lack.
Yeah.
That's what they're hyper focused on. That's why they get in trouble, dude. The minute that you start focusing on abundance solution ways, guess what you're going to find?
Yeah.
Abundance solution ways. I mean, dude.
It comes back to that saying, are you trying to survive or are you trying to thrive?
Yeah.
It comes back to one of that. And when a little hiccup pops up, why are you switching so fast from thriving to just trying to survive and keep what you have? You want to continue to always be thriving. And
dude, safe is actually risky.
Scary.
Yeah, it is. Yeah. It's risky. Because, like, and you look at people, you think about this. You look at people who they acquire acquire wealth. And then what do they try to do? They get now it's just all about protecting it. You should be trying to protect it the whole way through, but they stop going after and pursuing more and just want to protect so that they don't lose because now they have more to lose.
Right,
dude. You put things in place to help you protect it. You want to know? Do you want to know another beautiful thing about the? So first,
yes,
before I go back,
I do want to know that. Yes,
but you guys, I was about to go down another tangent, but. Dude, it's focusing on the abundance and acquiring. And yes, you protect, but it takes just as much energy to go get than it does to just freaking protect all the time. You put legal structures in place to help you protect. I also believe that that's a scarcity mentality too. Some people don't put those legal structures in the beginning. Why? Because they don't want to pay the money to structure properly to protect their ass and their assets. So what happens? They get in trouble down the road.
Right, or they don't want wording to say something to push away a potential investor. So it goes back to being a scarcity in there.
And think about this, man. So you think about somebody who, let's say that you are deciding that let's say somebody decides that they want to invest in their own single family property. Okay, I have a couple $100,000, whatever it is. And I'm going to go invest in a single family property because I want more, right? Instead of investing in a syndication where, they don't believe they get more, right? And it's just education.
Right.
But really returns on time and money. Money,
and effort.
Even if money balance out,
yeah.
Time is a return metric that most people don't look at. But the point is, now let's say that let's say that you get sued for something that is not even related to your property. Well, those people can go after things that you own as the primary, as the general partner, whatever it is, right?
Right.
Which means they can go after that house, that couple $100,000 that you sunk into there. But in a syndication, like they're a limited partner in a syndication, in our fund, in a whatever. And so those people can go after it, but they're not going to get it.
Never.
Why are they not? And they know they're not going to get it. Why do they know they're not going to get it? Well, because as a general partner, my friend is my investor.
Right.
So I'm not going to be sending a distribution to that investor if I know that is going to just get taken. So I'm just not going to distribute. I'm just going to weather it out because I'm going to take care of that person.
Right.
So then what happens? But dude, these companies, they know that. And so what do? They settle for a whole lot less. So once again, it's another way to protect you, dude. I can't remember how I got down that rabbit hole. But
it's just another way to provide value, though.
Yeah. Yeah.
Right? We're talking about other ways to provide value here, and that's just another way that it provides value for the investor.
Are you okay? Jackson took a drink, and I'm pretty sure it went down the wrong hole.
I'm good.
Are you good?
I'm good.
I'll come over there and Heimlich your ass.
No, I'm good.
Okay.
I might enjoy the Heimlich, though. Okay, awesome. No, dude, that's awesome. That's awesome. Last question here that I wanted to ask you. Was there any other reasons that you feel like, right, because this all started because we wanted to talk about how the Kahi Fund filled up in 48 hours. Uh-huh. We've talked about providing value. Is there any other reason you feel like the Kahi Fund filled up in 48 hours so quickly?
Sure. I'm gonna mention one more thing that sparked this, but why did it fill up? Well, because we structured properly. We didn't try to keep, which of these things is important. Just try to, keep so much. But what that will do too is allow us to raise way more money way quicker from forever, dude, until we decide to have a scarcity mentality.
Yeah.
Because, which means, our percentage may be a little lower, but it's going to be of a way bigger pie than just a slice of pie, right?
Right.
Because we're able to do more at a higher scale at a bigger rate. Yeah. And, I believe one of the ways to make millions and millions is to impact and benefit millions and millions. So bigger scale, right? But consistency, dude. I mean, consistent effort and execution for years. Like, do you know how hard it used to be for us to raise, dude, $1 million?
Take a while.
Hard.
Yeah.
Calls. I mean, dude, hard, man. But we continue. We talk about what we do every single day. Mm-hmm. Every day, man. So like those individuals out there who are looking to passively invest, hey, we'd love you to be a part of anything that we do. Grateful for our investing partners. So those of you who are looking to also actively invest, understand that, man, this compound effect, right? This consistent effort, but also execution over years will compound and will benefit you as long as you continue to focus on abundance. As long as you don't get caught in a scarcity mentality, right? And you truly do, your value metric, like we talked about earlier, is in the right direction, which is providing value and taking care of those that you're serving, right? So consistent effort, man. Our model is great. You know, we have a great track record. But dude, it's consistent effort over a long period of time. And long period of time, we started all this in 2014.
Yeah.
So long is,
7 years, 6, 7 years.
Yep.
Yeah.
In the whole scheme of things, that's so short.
I know.
Long is all perspective, right? But dude, it's funny, man, because I listened to a podcast today in the shower, and the guy it was Ed Milet's podcast, and the guy that was on there was Phil Heath, and Phil Heath mentioned, it was totally off topic, but I'm going to mention it anyway. Yeah. He mentioned how he's a bodybuilder. Dude's a
beast.
Sure.
He's on Ed Milet's pilot. I mean,
wait till I show you. You guy's a stud, dude. But he said, I used to never, I wouldn't even look at my trophies, I think was the example he gave. Okay. I wouldn't even look at my trophies. I would just, because I was like, well, who cares? What's next? Well, I'm a very goal-oriented person, man, and I have been, ever since I learned how to set goals, I've been very goal-oriented. Yeah. And I very rarely, if ever, will I ever just sit back and look at those kind of things. But dude, this morning I did, man. I sat back and in my meditation this morning, my meditation was, I dropped the kids off at school, and then I just sat in my truck in Marley's school parking lot and meditated and reflected on those things. The companies that we've created, the impact that we've made, the life that, I've been able to create out here, the relationships we've been able to make. Dude, that was awesome. That was an amazing thing, man. It provided just a little couple seconds of that. And it was a few minutes, but 12 minutes to be exact. But created massive gratitude, man. And gratitude is one of the strongest emotions in the world. So anyway, consistent effort and execution will come back in so many different ways.
Thank you for sharing that last bit too, as an actionable. Do that if you haven't lately. Take a minute and give yourself a pat on the back for all the hard work that you've done and all the things that you have accomplished. If you haven't accomplished anything and you haven't done any hard work, I ask you to look a little deeper, because I'm so glad you did that. I'm sure there is something that you've worked hard for and that you have accomplished and that you should be proud of. So find that and enjoy that for a moment. I think that I've experienced something very similar to that recently, where you just sit back and look at everything for 2 seconds. And it just brings gratitude, immense amounts of gratitude. So no, thank you for sharing that. I think that's a great, and that feeds right into abundance too, because you'll want more and you'll want to provide more, and it'll just motivate you to do great things. Gratitude. So, a Hawaiian value we could wrap up with. The thought was akahi. You already talked about akahi.
Let's do it. Akahi aloha.
Akahi
One
aloha.
One love. Yeah, we'll just go there.
Yeah.
One of many. You're going to be learning a whole bunch of Hawaiian numbers because we're going to have a whole bunch of funds. And
yeah, I was going to ask. That was going to be like the last little drip here. Do you want to tease the next fund? We're not quite ready. There will be another one.
Yep.
with very similar structure. This one filled up in 48 hours. So if you are a passive investor, chances are you're going to want to jump into our second fund as well.
We'd love to, man. We'd be honored for sure.
Yeah.
But hey, thank you all so much for listening. Thank you for the episode, bro.
Thank you, bro.
It was a fun one.
It was a good one.
I hope you gained some value from it. And if you did, man, leave a review, share. We just want to know, man, more than anything. Even if you send something privately, we just want to know that if it didn't connect. Hey, I thought this one was dog shit. Don't do that one again. I want to know those things too, Feedback is critical. So we love y'all. Hey, seriously, thank you guys so much. Whenever you're listening to this, we love you. Hope you have a great weekend, a great week, a great day whenever you're listening. And live always with aloha. Peace.